What's up? I'm Dan Fredenberg, and this is another chance encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with Mike Angelo. How you doing today?
Doing awesome, Dan. Good to see you, man.
Yeah, for sure. And I got some great news for you, Mike. Today, I don't know if you know this, but we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate syndicators, players, deal sponsors, operators, buyers, sellers, all that kind of stuff. And you may sit there and go, why would you do that? And the answer is if you've heard of off market deals, the private deals that you're actually not allowed to discuss in public, it's also sometimes called a 506B deal, then you would know that the SEC requires that you have a documented prior substantive relationship, or else the SEC will get ants in its pants and it's a house of cards. It's no good. So that's why we need to have each other on and talk about level of sophistication, appetite for risk, core competencies, and all that kind of stuff. But the benefit to you is that you will learn how to more effectively communicate on the subject of commercial real estate deals and understand how my guest fits into those deals, even if you're starting from zero. But before we get too excited about business, Mike, do you want to say a thing or two about yourself?
Yeah, awesome, man. By the way, that's a great way to introduce that. I love that. That's awesome. So yeah, Mike Angelo, we are Nimble Capital. It's my business partner, Michael, and I. We started about 5 years ago. We're in the multifamily business, so development and value add. I'm based here in Phoenix, Arizona. Got to meet you at Race Fest the other day, which was awesome. We focus on assets in New Mexico, Texas, and Oklahoma, and we're doing a ground up development here in the Phoenix area. So super glad to be on here.
Awesome, beautiful. And the first segment that I always do in these chance encounters, it's the five distinct motivations. Before that, I gotta say, but wait, check your rate. Mike, I don't know if you have the ability to see through the camera in your device and down there into the user's device, but there might be this hideous subscribe button down there that you might okay, okay, it's a stupid joke. But I do it in every episode.
The button. Hit the button.
Exactly. Now, the five distinct motivations. It is a fact that everybody has their own unique why. And I've spoken to, at this point, like, must be at least 1,000 different players in this space. And I found that these different whys, they fit pretty neatly into these five different categories. But the thing that's really important, and the reason why we have to ask each other this type of question, is because these deals take months to close. They take years to go full cycle. And so it's really important to know what's going to keep somebody from throwing in the towel when the going gets tough. And here are the five categories that I found really are the most descriptive. The first one is preservation of purchasing power. What on earth is that? Well, some people are job optional, work optional. They don't need to hold a job. And the reason for that is because they've got a portfolio of assets. And then the way that they pay their bills is from the proceeds of ownership. In other words, those profits of what they own. And if you're in that situation, or at least if you're thinking about people in that situation, you might go, well, why would you bother going through all this hassle and risk to make another acquisition? And I found that there are two main categories of incentives for people like this to make their next acquisition. The first one being if inflation is rearing its ugly head, that's going to eat away from the purchasing power of your cash flow. So it's going to be time to make a new acquisition. The other time is if there's an asset crash or you're aware of a steeply distressed property, then you can buy at a big discount, and then it's going to be worth all that additional effort. Now, of course, that's going to be buying at a discount is a part of everybody's real estate acquisition process. But quite frankly, I'm not to that stage in my real estate career where that's my main motivation. My main motivation is getting to that point and doing it through trading time directly directly for deployed capital, aka equity. And hence, then the reason why that came to mind is because I've got a background in technology. Specifically, it's in the CRM industry. I had my own agency starting in 2011, and I started into real estate in 2014, watching my boss flipping 10 houses a month, doing these 10 transactions a month. And between the tax advantages and the tax disadvantages of being a high wage, high salary earner, it made me very clearly say, hey, I need to pivot and find a way to be rewarded in the form of that deployed capital. So that's what I'm up to. And I get that that's a little too abstract for youngsters, especially. But what youngsters tend to gravitate towards is they want to hustle like crazy for now, and they want to fast track their retirement. And other people will have a similar motivation, which is better described as wanting to take control of their schedule. And that way they want to, say, work fewer months per year or fewer weeks per month or something like that. And that is, it's a great way to have that sort of opportunity. However, one thing that's funny about this group, I find, is they tend to think that secretly it's everybody's motivation, and then they're just in various levels of hiding it. But I assure you that is not the case. There are some people who are driven by ambition. They want to buy their entire hometown. They're after that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And that's why they're hustling like crazy now. And they're going to continue to hustle into their 90s. And so, even though that's vilified in some circles, the fact is, you need people who aren't going to quit if you're going to make this stuff work. And so, they're fantastic members of GP teams. Now, the last group, they're also similarly motivated to keep on hustling, even into typical retirement age, but their focus isn't so much on their own generational wealth or their own reputation. They're more concerned about how they picked a sector of society, or maybe it's animals or the environment, who knows what it is. They want to make a big impact on society, or this whoever they're focusing on, and they've chosen commercial real estate as the vehicle to increase their financial backing to make that big difference. So, Mike, of those five different motivations there, what combination of those would you say describes you best?
Awesome, man. So time with family, generational wealth, and giving back.
All
So
right. I love
yeah.
it. I love it. I love it when people keep it simple like that. And of course, when we're talking about motivations, quite frankly, it's pretty easy to end up sounding naive or optimistic. But every business has risks involved, and real estate is absolutely no exception. And if you've ever been involved in a 506B deal, whoever the securities attorney in the mix was, and there really should have been one, otherwise you should run away. You shouldn't just
Yes.
walk, okay? But whoever the securities attorney was, they should have insisted that every limited partner, every investor, everybody who's involved, they had to fill out this really invasive financial questionnaire. Sometimes it's called a suitability questionnaire. And when I was filling out one of those forms, actually a bunch of them, I found the tolerance for risk assessment question. I thought it lacked utility. Like, you couldn't really use the answers for anything meaningful, and you're still basically guessing if the person understands what an illiquid asset is in the first place. So I made my own tolerance for risk assessment question, which is a fill in the blanks. It is, there are many popular investment asset classes, but I think blank is too risky. So, Mike, it can be inside real estate, it could be outside real estate. What's too risky for you?
Crypto.
Crypto.
Crypto's too risky for me. I know there's a component of it in the future coming. It's going to be government controlled. It's, to me, it's not in Bitcoin. I did buy some stupid Dogecoin, which is worth like 0.0006 now or whatever it is,
Mhm.
just because I didn't want to miss out. I had that FOMO, but I don't understand it completely, and I don't think it's going to be the. It's, to me, real estate just makes sense. It's brick and mortar. I can touch it. I can feel it. Crypto, I can't.
Yeah, I love that. And fundamentally, with crypto, it's an appreciation move, full stop. There, because you don't earn any cash flow for owning it, so you don't have any money coming in the meantime to offset any possible losses you make if you time it wrong. So I love that answer. And now, of course, the next slide here. Originally, when I started Chance Encounter interviews, I shied away from asking this question despite it being vitally important. And the reason why I shied away from it is because I know some people in this business, they're more like a public relations role or marketing role, and they're not really comfortable being up to their eyeballs in spreadsheets as, engineers and financial people tend to be. But even if you are that, not so much the underwriter, not so much the spreadsheet jockey role, you still will have some metrics that you hone in on to decide, okay, this one seems to be a more viable acquisition than others. But for anybody in the audience who's simply listening and not watching, I always read out the different entries on this slide, and they are cash on cash, IRR, cost per door, net operating income, also called NOI, the going in cap rate, which is actually talking about the difference between the going cap rate for similar properties in that area versus what you're actually paying for it. Then there's the loan interest rate. That will be very important, especially if you're assuming a loan. The occupancy or vacancy rate is the next one. It's the same thing, it's just inverse. The average income where the property is located, the amortization period of the loan, especially if you're going to be assuming it, the difference between the market versus the in-place rents, the population growth where the property is located to have some baked in appreciation right there, the sponsorship record, the record of the sponsor as in how many deals have gone full cycle and how many are on the go right now, the waterfall split or exit strategy that has to do with what's going to happen after your capital has been returned. Like, do you continue getting more income from that investment, or are you basically cut off? And then the last one that I have on here, which of course is not these are not the comprehensive, that's not every single metric out there, but I have DSCR, which is debt service coverage ratio, as the last one, which is about how much of the revenue is going straight to the cost of the loan before it can possibly hit an investor's pocket. So, Mike, what are you, like a top three or something? What are the main metrics that you focus in on?
Yeah, so two things. So as an operator, right, we're focused on cost per door, cap rates, IRR, right? Because we're going to go and pitch that to an investor. Cash on cash is critical on the value add side. So there's three or four that are there. But I'm going to flip it as an LP. I'm looking for sponsorship record. Like, what's the record, right? You have that further down in the list. To me, that's the most important thing. And so as your audience is thinking about deals, you're betting on the jockey, not the horse. The deal is going to be the deal, and anyone with a good PowerPoint ability can make those numbers look fantastic on a spreadsheet, right? But what's their track record? What's their history? How much are they investing too, right? That's really probably the most important thing out of all of that.
Mhm, mhm. I absolutely agree, and I'm definitely using the teacher's mentality of, how the right answer is always C.
There you
So
go.
I deliberately have to put, like the people who are really PR, like every single time they're going to say cash on cash, cash on cash, cash on cash, and it's like I really need to be hearing sponsor
Yeah,
record.
sponsor record for cash on cash. Of course, it's important, right? That's
Sure.
that's a big piece of it, but that's the marketing side. But really digging in and understanding what the deal is going to be on the backside, because you can take an okay deal, low cash on cash, and have it crank out and be double digit, or the opposite, right? You can have a great looking deal and a terrible sponsor, and it can crush the deal. So
Mhm, mhm.
we
Absolutely, exactly. And me going for time for wealth, IRR is what I'm focusing on, which is pretty
yes.
rare for my age. But anyway, I'm just eating up that answer like a delicious subscribe sandwich. This thing just tickles me every single time. And it's my reminder, it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And the whole idea of me going through these different sides in every episode is to make sure that you learn how to effectively communicate on the subject of commercial real estate deals, and also so you understand how my guest fits into those deals by mentioning their core competencies. And if you're looking at this die and this cube here and going like, wow, I really need me one of those, well, the good news, it's completely free. You go to dandoesdeals.com and there's a great big conspicuous looking button that you can click on and download and print it out for free. And like a complete dummy, I committed the cardinal sin of marketing, which is you should never, ever, ever give out your freebie without at least asking for some sort of contact information. But it's just plain that important to me that you start using these terms because I think that you can cut through the conversation very quickly. And the most important thing is if you are going to have a future in commercial real estate, your ability to express yourself and discuss these different roles clearly, it's going to hinge on that. So let's get started. Repositioners are acquisitions people, and they're the most visible ones of the bunch. Chances are, if you're meeting a commercial real estate person, there's a good chance they are repositioners. And what are they doing? Well, they're looking at a whole whack of different properties. They're doing a whole whack of paperwork. The paperwork is underwriting the deal, doing those projections, figuring out also, is this property even making the amount of money that the seller slash broker claims it is? Because okay, so the repositioner's job is to find upside. They not only have to find great properties, but they also have to know how they're going to change how the properties run to find more upside. And I would say the most peculiar part of being a repositioner is all of them have to have financier relations. What's that all about? Financiers are people who only deal with paper and money, and the owners of the building, they do not deal with residents of the buildings or anything like that. They are not on the GP team. Okay, so some people like to focus on financier relations, and maybe they do that through a fund. There's a few different ways of doing it, but the important thing is if the repositioner has a large enough network of financiers, then they're likely to secure a more advantageous loan, and that goes to the profitability directly of the property. So cheaper money equals more profit. So that's what they're up to there. Now, the next place the repositioners typically look, it's the operations. Got to make it more efficient. Stop those Benjamins from going down the toilet. But of course, there's more to operations than just simply unclogging toilets and collecting rents and mowing lawns or shoveling snow if you're like in my neighborhood. The things that I am able to contribute to operations teams, one is the web-based assets and CRM skills that I have from my tech background. But the bigger one to understand about operations is the enemy in real estate is vacancy. And if even if you're involved in bigger multifamily, like 100 units plus, like I've traditionally focused on, you are probably going to be outsourcing to a third party property manager. But if they can't get those units filled, somebody on the GP team needs some serious marketing chops and step in and get those units filled. So that's one of the contributions I do. But of course, there's only so much you can do with operations. So the next place the repositioner generally looks is to get a contractor team involved to renovate the place, make it nicer. The idea being that the next resident would be more than happy to pay more in rent than the previous one because the place is nicer. But if only it were that simple. You can spend endless amounts of money on contractors. You could go ahead and gold plate the toilets, but you're not going to get a return on investment. So one thing you're going to have to do to make sure that the contractors aren't they're not using sub adequate materials, they're not dragging their heels, especially if you're like me. I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground. Somebody who can be there in an hour or two, because categorically, that's not going to be me. I'd still be stuck at an airport in an hour or two. So I need to have somebody who can drop everything and be there in a short amount of time. You know, if there's a water leak or something like that, and the property manager is just simply not suited to take care of it. But let's do a hypothetical. Let's say you are an engineer or a physician or an attorney or something like that, and you're becoming a repositioner. You get the idea in your head like, hey, I know how to buy a house. You just have your down payment and then I get a loan and I can pick it up. So maybe my friends and I, we can each put in like 100K each, and then that beautiful 350 unit apartment complex just down the street, we could pick it up together. So in that hypothetical, you turn around to the financiers and say something like, I really want to get this property. It's tens of millions of dollars though. Do you happen to have, say, tens of millions of dollars you want to lend us for this? Well, there's one big problem with the plan as I've illustrated it just now. And if you're in some sort of mentorship program or a guru program, I highly encourage you to pay very close attention to this one because they really gloss over it. The financiers are going to ask, who's the sponsor? Who's the KP? What's that all about? In order to be eligible for a commercial loan, you have to have somebody in the fold who already owns a similar asset. And that's because they need proof that you're not going to just run it into the ground and lose all their lenders' money, basically the bank's money that they get from different depositors. They don't want you to lose all that money. So that's why they have to have somebody in the fold who already owns a similar asset. And then they're also going to ask for a certain amount of liquidity. And then among the ownership team, you need a balance sheet, in other words, the collateral of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So, Mike, as far as you and your organization goes, which of those boxes are you most likely to check in your next deal?
Yeah, so we do wear a lot of hats, and we're about 4 years in. So originally, I started out as that repositioner, the underwriter, finding the deals, putting it together, found our financiers, found the team, and really put it all together. Went through a mentorship, and you're 100% correct. They absolutely gloss over that key component. So you have to have the team put together first. Go find some deals, and then go tackle the market. So today, we've kind of graduated to a point where we can actually sponsor up to about 20-25 million dollars worth of projects, and we're still always, hunting for capital. So we work with, retail investors on that front. My business partner's main role is that, and I'm really the deal structure guy. So I find the opportunities, I put them together, do the marketing component, and then we go out there and pitch it out to our investors.
All right, I love that. And you already addressed some of my next question, which is about the buy box. But just so you're clear about this, when real estate people are asking each other, hey, what you looking for? What's your buy box? What's an ideal property for you? What should I bring you? We're really asking about three main things first. The first one is geography. Where is it? Which state? Which county? Possibly even which neighborhood? Okay, it's absolutely going to matter. The second one is size. And most of my guests on this show, they are in multifamily, which is apartment complex investment. And the way that you define size in apartment complexes is by the number of apartment units. And the reason why it's important to know the size of these properties is because the type of team that's going to be taking over 10 unit apartment complexes, 15 unit apartment complexes, they're going to be fundamentally different from the ones that are dealing with 150 and those bigger properties. So that size is going to matter. And of course, there's other forms of commercial real estate that go off of acreage or square footage, but that's still the reason why that size is going to matter. Now, the third one is usually called class. I'm not a huge fan of that term because I call it desirability, but it's also split into two really distinct parts, and those are the condition and the area. And if you're talking about the condition, that's how old is the facility, the building on the property, how beat up is the property, and then, of course, what sort of luxuries and amenities do they have? Is it a really, really nice place where people want to spend time there, or is it just a place to basically hang your hat, as they used to say? But when you're talking about area, especially when you're talking about residential like multifamily, the school districts where the property is located is going to be very, very important. And then regardless of the type of real estate, the crime rate is going to be really important. But of course, brokers love to say location, location, location. I'm not a fan of that trope just because I don't think it's very informative. It doesn't really tell you much that you can use. So the version of location, location, location I use is traffic, traffic, traffic. If a gazillion cars pass by any property on any given day, it's automatically going to be more desirable than one that doesn't really have that much traffic. But both the area and the condition, those two versions of class or desirability, they're ranked the same way as in grade school. So you have A plus at the top, and then A minus, and then B plus, and so on. So Mike, I know you mentioned some of your buy box already, but we got some virtual assistants in the audience
Yeah.
who are diligently typing your answers for their investor base. But what's your buy box?
Yeah, great. And it's evolved, right? So when we first started, we were really focused on that class C, C plus really space as far as both the property itself. So vintage is really critical. We were much more open to older assets. I'll tell you today, 4 years later, we won't buy anything less than 1985,
Mhm.
right? So meaning older than 1985. We own 1960s, 1970s assets today. We're ready to move up to the newer product. And why? Operational costs, right? Just some of the renovations, having to retouch some of those older mechanical systems. So really challenging on the vintage, but the class areas definitely B plus down to C plus. And that's so subjective, right? Depending on where you are. And what I'll tell you is we're not looking at any new markets anymore. We have San Antonio, we're in Tulsa, Oklahoma, a couple cities in New Mexico, and then of course here in Phoenix. And we have sub-market criteria, meaning not just the city, North San Antonio, between North Star Mall and the airport. Like that's our buy box. It's interesting to know that because as soon as I see another property, I just save myself maybe an hour of time to underwrite. Why bother underwriting? It's not in our buy box, right? So that's made life much easier, and it's actually better for the brokers because they know, hey, Mike only wants this, and we only want to buy 200 unit plus apartment sizes. So I mentioned, 25, 30 million. That's about our spend. And that makes it really crisp for those guys looking for product for us or opportunities for us.
Awesome. Awesome. So you
Yeah.
can just rinse and repeat. I love it. So the
Yeah.
next question then has to do with people. And my favorite part about getting into this industry, especially from tech, we have in tech, there's a lot of antisocial people. And I don't think I'm really rocking any boats on by saying that little revelation. But the thing that I find is that because it's a multifaceted industry. Each person has their own separate roles, and you can't do all six sides of the die for any meaningful amount of time. So you are going to hunker down on one or two of the different roles, probably two at least. But the fact is, because it's a team sport, people are so eager to give introductions, make referrals, even if they're not going to be on that particular team. But because we have our own unique skill sets, we're better at helping some people than others. And me personally, because of my tech background and from I'm getting closer and closer to loan companies, I find like debt funds and whatnot. The sponsors and KPs I'm most eager to speak to just because they've got that foundation. They're not just starting up on their first few deals, so I can make a disproportionately large difference. Whereas locals and repositioners usually they need grunts who can put in 80 to 120 hours a week just calling and calling and calling people. So I'm eager to speak to them. And then at the end of the day, we're all in the business of allocating capital. So financiers are key for the people who I need to speak to. But Mike, if you have any 506B deals, don't go mentioning the deal and saying
Yeah.
that you need investors for it. But who's out there that you're most eager to speak to?
I would say, we're always looking for kind of that next tranche. Like my role specifically is looking for pref equity. So we have a lot of 506C deals, right? So Charlie deals we can talk about. Um, the next level. So the retail investor, we have a funnel of folks that come through, great, build relationships, etc. And when we have B deals, we'll go back through and say, hey, we have some opportunities, but Charlie deals we're allowed to kind of promote. Um, but yeah, the next phase for us is as we graduate through your first few deals, 6, 7 deals now, we're really looking for that bigger check writer, right? To be honest, is could be a debt fund combo, but really the larger equity pieces and always finding new and creative ways to finance deals, right? Right now, seller financing and or loan assumptions is all the rage because interest rates are through the roof. So being able to creatively put those together just is one of those things that's what we're really kind of focusing on now is how can we go tackle the market because your traditional way of approaching underwriting is kind of blown up. It doesn't work, right? So you really need to be creative and understand that, and then be able to mirror that to your investors' needs. And so, again, I think it's training some of our current investors, but who are we looking for? We're looking for folks that are bigger check writers.
I love it. I love it. And so, if anybody is in the audience saying, "Hey, I really need to reach out," then, well, I'm going to hijack the conversation and talk about myself. So, you can go ahead and use my very distinct looking last name and find me very easily on LinkedIn, which is the social media platform where I spend most of my time. So, that's a great way to reach out to me. And of course, I have some different books on business related things, including real estate, that are available on Amazon. But if you are involved in syndications, if you're talking to investors, potentially raising capital or whatnot, I highly encourage you to pull out your phone, scan. You can pause the video if you want. You can scan this QR code, and that brings you to the FAQs page of 506BME, which is the platform where I help different syndicators store with IT the documentation of your substantive relations. The idea being that if your laptop falls into the bathtub and the SEC audits you and says, hey, you need to prove to me that you knew everybody who was involved in your 506B deals, or else we're going to force you to pay everybody back plus interest and then possibly bankrupt you. And that's criminal allegations of fraud and orange jumpsuit
Orange
territory.
jumpsuits is what it
Yeah,
is, man.
exactly. No pressure or anything, but you know, it's I kind of have that buttoned up, and the bigger thing too is I also have used some neat little tricks to avoid plausible deniability. So if people decide to accuse you of public solicitation, you say, okay, well, explain this, and that's how I can help. But Mike, if people want to reach out to you, social media, phone, website, how should people reach out?
Yeah, awesome. I'm also on LinkedIn. It's Mike Ashish Angelo, Nimble Capital Group. We have a page there, Facebook, Instagram, Nimble Capital Group. Just look out for us there. And I think it's Multifamily Mike on Instagram. So love to go out there and help. I love that you talk about this relationship piece and documenting it because we're all on social media and I see so many deals or excuse me, so many posts that will get you put into an orange jumpsuit. And it's just purely because it's not like those people have malintent, they just don't know. And so it's just really going out there and educating and spending time to make sure you do it correctly, get a good securities attorney. So first thing we did, by the way, we didn't even have a deal. We just had securities attorney. What can we do? What can we promote? And they said, you can't do this, can't do this, can't do this. Like, okay, right. I'd rather know now and not have to have, handcuffs on and then say I didn't know. Right. So I love that you do that. It's a great thing to do.
Awesome. Yeah, absolutely. And you know, we all need an environment, a circle of people where we know that, you know, we're not risking our investor dollars just
Yeah.
because of somebody's ignorance. So I love that way of summing it up. And while we're doing public service announcements, Mike, this one's not for you, it's for you in the audience. If you've been watching this episode and experiencing like searing pains in your eyeballs, like maybe migraine like symptoms, I'm confident it's because of the downright hideous subscribe button that you can just get rid of it. Like you can get that out of your life. You just it doesn't cost you anything. Full disclosure, I want people to click on it because if enough people do, YouTube will actually start paying for these videos instead of me. I think that would be amazing. And the trade-off to you, just so that we're clear, it's again, it doesn't cost you anything. It just means that my videos may show up on your list of suggestions. It's not like death and taxes where it's definitely going to happen. But quite frankly, if you see those suggestions on your timeline, you can just go ahead and ignore them if that's what you really want. I just appreciate the fact that you spent this time with me. Just like Mike, I appreciate you joining me today. This has been awesome.
Absolutely. Thanks for having me. Great to be a part of it. And yeah, thanks again.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B Me or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.